Let us see the next question. A firm is willing to purchase new machinery and is having two options. Information related to the options are as follows. Option number 1 and option number 2. Cost of the machine is given, life is given, salvage value of the machinery is given, expected earning on after tax basis is given. The firm charges depreciation on the machinery as per SLM. Discounting rate is set 14%. The present value at 14% is provided to us year 1 to year 6. You are required to evaluate both the options on the basis of discounted payback period, NPV, and profitability index. So there are three methods by which we are required to evaluate both the projects. One is the discounted payback period. So we'll compute the discounted payback period for both of them, and the project which is having lower discounted payback period is preferable. NPV. Again, based on the NPV, so the project which is having higher positive NPV will be selected. And the third is PI. Based on that, so the project which is having higher PI will be accepted. The language of the question clearly specifies that, say, using these three criteria, you are required to tell us that, say, which project is to be accepted. So we just have to apply them for the purpose of decision making. Over here, life of both the projects are different. That point is not required to be considered by us. We just have to follow the language of the question, in which using these three specific criteria, we are required to give the answer. Please write an answer. First point, in this question, comma, we have to give decision comma using different criteria. Second point, we have to compute NPV, comma, project having higher positive NPV will be given priority. Full stop. Discounted payback period, comma, project having lower discounted payback period will be given preference. Full stop. Similarly, project having higher PI and more than one will be given preference. Full stop. Heading right down, discounted payback period. So step number 1 is investment. Option 1 and option 2. Amount of investment to be made is 30 lakhs in year 0 and 35 lakhs in year 0 for project 1 and 2 respectively. Step number 2, depreciation. We have been provided that's the SLM method of depreciation. So depreciation is equal to cost minus scrap value divided by number of years. For both the options, for option number 1 and for option number 2. For the first option it is 30 lakhs minus 5 lakhs divided by number of years 5. So 25 divided by 5, that comes to 5 lakh rupees per year. For the second option it is 35 lakhs minus 5 lakhs, 30 lakhs upon 6. That comes to 5 lakh rupees per year. This is the way the depreciation can be calculated for each of the option. Step number 3, terminal cash flow. In that, first option and second option, it is scrap value of the machinery. That is an amount of 5 lakhs for first option and 5 lakhs for second option. In case of the first option, that is going to be received year 5 end. And over here it is going to be received year 6 end. The amount of the depreciation is going to be claimed year 1 to year 5 for first option and year 1 to year 6 for the second option. That is with the depreciation to be claimed annually and terminal cash flow that will be received at the end of the 5th year, at the end of the 6th year. Step number 4, recurring cash flow. For option number 1 and for option number 2. Earning after taxes is provided to us 7,75,000 and this is 8,25,000. Of course, we understand that so the earning after taxes is after depreciation. So we add back depreciation. Why? Because it is a non-cash item. And this non-cash item must have been deducted in calculation of the earning after taxes. So recurring cash flow will be in the first case 12,75,000 and in the second case it is 13,25,000. This is the recurring cash flow. For option number 1 it will be received year 1 to year 5 and for the second one it will be received year 1 to year 6. Step number 5, discounted payback period. For option number 1, it will be calculated first. See friends, over here, the income tax rate information is not given to us expressly, yet the calculation of the depreciation is required to be made. Why? Because we have been provided with the earning after taxes in the question. So it must have been calculated after deducting the depreciation. So we add back depreciation for the purpose of calculation of the cash flow. This is what we understand. So let us calculate further answer. Discounted payback period. In that, column number 1 is year, column number 2 is cash flow, third column is present value factor, next is present value cash flow, and the last is a cumulative value, and that is important. End of year 1 cash inflow is 12,75,000. End of year 1 factor is 0.877. Dear students, remember that the factors have been provided to us in the example. And whenever we have been provided with the factors, it is mandatory to use them only for the purpose of doing answer. If at all you are not using them, then in that case you will not be given marks. It is 11,18,175. 11,18,175. Second year the cash flow is same, 12,75,000. Discounting factor is 0.769. So 12,75,000 into 0.769. 9,80,000. 475. So the cumulative value is 2098,650. Third year it is 12,75,000. Third year factor is 0.675. So it is 8,60,625. So 29,59,275. Fourth year 12,75,000 once again into 0.592. So it comes to 754,800. Cumulative value is 37,14075. Dear students, in fact beyond this, so there is no requirement to calculate. Why? Because the amount of the investment that we have made, 30 lakhs, is recovered by this time period. Yet preferably let us make the calculation. So later on for NPV calculation and for BI calculation we will have these values that will help us. That is the reason I am doing further working. Otherwise it is not at all required. 12,75,000 into 0.519. So it is 661. 6,61,725. And this time friends, you cannot make the computation of the cumulative cash flows, that is present value. The reason is that exactly you need to know that what is that is in which year we are able to recover the investment. So we do not have a choice but to do the working on year to year basis. So 12,75,000 plus last year we will have an amount of 5 lakhs. So it is 17,75,000. Last year factor is 0.455. So 807,625. So 51,83,425. Now friends, we understand that we are able to recover the investment after third year and before fourth year end. So the discounted payback period is more than 3 years but less than 4 years. So discounted payback period is equal to 3 years plus the amount of the investment is 30 lakhs minus by end of third year what we have been able to receive 29,59,275. So difference of both of them is the amount which is yet to be recovered divided by 750 for 800. So this is the way we can make the calculation. 30 lakhs minus 29 lakh 59,275. So 40,725 upon 750 for 800, that comes to 0.05. So it comes to 3.05 years. This is in case of option 1. Friends, over here the life of the project is only 5 years. So this amount is 17,75,000. So 17,75,000 into 0.519. So it is 9,21,225 plus 3714,075. So 46,35,300. This is in case of project 1. That is first option. Now next, option number 2. For that, so we'll make the calculation of the discounted payback period. Option number 2. Calculation of discounted payback period. In that, column number 1 is year. Column number 2 is cash flow. Third column is present value factor, present value cash flow, and cumulative cash flow. So it is 13,25,000. First year 13,25,000. Second year 13,25,000. Third year 13,25,000. Fourth year 13,25,000. Fifth year 13,25,000. And I will be careful this time. In the sixth year it is 18,25,000. This time it is 6 years life. That is 13,25,000 plus 5 lakhs. Okay. Now present value factor. For end of year 1, 877, 769, 675, 592, 519 and 455. Okay. So 13,25,000 into 0.877, 11,62,025. 11,62,025. 13,25,000 into 0.769, 10,18,925. 21,80,950. 13,25,000 into 0.675, 894, 375. So 3075, 325. 13,25,000 into 0.592, 780 for 400. So 38,59,725. 13,25,000 into 0.519, 6,87,675. So 45,47,400. 18,25,000 into 0.455, 830,375. So cumulative value is 537,775. That is the way the cumulative cash flow is found. The investment that say we have made is 35 lakhs, which is recovered after 2 years, sorry, after 3 years and before third year end. So discounted payback period is equal to again 3 years plus 35 lakhs minus 3075325 whole divided by the fourth year cash flow. It is 7,84,400. So it is 35 lakhs minus 3075325, that is 4,24,675 upon 784,400. So it is 0.54. So it is 3.54 years. That is the way the discounted payback period can be calculated. Now second question. Second question is calculation of NPV. So NPV can be calculated as present value of the cash inflow minus investment. We are required to find it for both the projects, for option number 1 and for option number 2. For second option, we understand this is the present value of the cash inflow, 53,77,775, and investment is 35 lakhs. 53 lakh 77,775 minus investment is 35 lakhs. So NPV is 18,77,775. That is the way NPV for the second option can be found. For the first option, the present value of the cash inflow is this, 46,35,300, and investment is 30 lakhs. So 46,35,300 minus amount of investment is 30 lakhs. So NPV is 16,35,300. This is the way the NPV is calculated. Third, we have to compute the PI, profitability index. PI will be calculated like this. Next, PI calculation. It is present value of the cash inflow divided by investment. Again, it will be calculated for both the projects, for option number 1 and option number 2. For the second option, it is this, 53,73,775 divided by investment of 35 lakhs. So 53,77,775 upon 35 lakhs. So it is 1.5365. For the first option, it is 46,35,300 divided by present value of the cash outflow or investment 30 lakhs. It is 1.5451. This is the way the PI can be calculated. So now friends, discounted payback period, NPV and PI. So PI is 1.5451, 1.5365 for project 1 and for project 2. So we understand that say based on PI criteria, select project 1. That is the way we are required to give answer. NPV 16,35,300, and over here it is 18,77,775. 18,77,775. So in that case, the project 2 will be selected. Discounted payback period, it is 3.54 and 3.05. So 3.05, 3.54 years. So based on that, say we select the project 1. Why? Because it is having lower payback period. This is the way we are having, so the selection of either first project or second project with the individual criteria. Please write down answer. So there is a question that suppose we have to make a selection based on these three criteria taken together, then what is supposed to be done? Dear students, for this I am going to dictate a separate note to you later on, not at this point of time, because I want to give you some further explanation. But considering the question to which I have come across right now, I am telling you something like this. If at all there is a situation of capital rationing and the projects are divisible, then in that case you have to do the selection based on the PI criteria or NPV index criteria. Capital rationing, in that case projects are indivisible, combination. If at all the projects are mutually exclusive with unequal life, then in that case, if at all the projects are for one-time acceptance, then absolute NPV. If the projects are of repetitive in nature, then in that case equalize annual NPV. This is the way we are required to do the selection. So friends, over here, say just let us go through the entire answer once again, and in your examination be prepared for this kind of question. This is the kind of length that you will have, and this is also the kind of moderate questions that can be asked in examination. Step number 1 is investment, 30 lakhs and 35 lakhs. Step number 2, depreciation, even though expressly income tax rate is not given. So we can say that to some extent it is an important point. However, we can see that the earning after taxes is provided to us. So of course the tax has already been deducted along with the depreciation. So we add back depreciation to compute the CFAT. So second step is depreciation. Third step is the terminal cash flow. In that, say the scrap value of the machinery, there is no working capital. Step number 4, recurring cash flow is also extremely simple. For the first project it is 5 years, and for the second one it is 6 years. Discounted payback period is calculated for the first one. Remember that you cannot have the cumulative working, because exactly the year in which you are able to recover the investment is what importantly you have to compute. For the second option, again the discounted payback period is calculated. NPV calculation. So when we made the computation of the discounted payback period, we made all the calculations of the present value of the cash inflow. So second is NPV. Third is profitability index, that is present value of the cash inflow upon investment. And based on that, say we have a kind of selection of the projects. Over here we just have to write that based on the discounted payback period which one is better, based on NPV which one is better, and based on the PI which one is better. That is the only thing that we have to do over here, nothing else.